You know what's wild? Right now, there are people out there buying houses at the absolute peak of the market, and they have no idea what's about to hit them. They're walking into open houses, getting into bidding wars, stretching their budgets to the absolute limit, and they genuinely believe they're making a smart investment because everyone told them real estate always goes up, except it doesn't. It never has. And if you know what to look for, the warning signs are flashing so bright right now that you'd have to be actively ignoring reality to miss them. My name is Rob, and I've spent years studying real estate cycles, market crashes, and the patterns that show up right before everything falls apart. And here's the thing that keeps me up at night. We're seeing almost all of those patterns right now, not some of them, almost all of them. If you're thinking about buying a house, or if you just bought one, or if you're wondering whether the housing market is about to implode, you need to watch this entire video because what's coming could be the worst housing market in American history. Make sure to hit that subscribe button and give this video a thumbs up if you want to understand what's actually happening in real estate right now instead of just listening to your realtor tell you that it's a great time to buy. Now, before we get into the current warning signs, let me explain something that most people completely misunderstand about housing crashes. Every single crash is different. The specific triggers change, the specific mechanisms change, but the underlying patterns are always the same. It's like how every car accident is different, but they all involve the same basic physics: speed, momentum, impact. Housing crashes work the same way: rising rates, declining affordability, collapsing demand. The details shift, but the fundamentals are identical. Right now, everyone's saying this isn't like 2008, and they're right. It's not like 2008. We don't have the same subprime mortgage crisis. We don't have the same levels of adjustable rate mortgages blowing up. We're not technically in a recession yet, but here's what they're missing. We don't need the exact same conditions as 2008 to have a crash. We just need the right combination of factors to kill demand, and we have those factors right now in abundance. Let me break down the three key drivers that cause housing crashes, and you tell me if these sound familiar. First, interest rates. When rates are low, everyone can afford to borrow more money, which drives up demand, which drives up prices. When rates rise, suddenly nobody can afford these inflated prices anymore. Demand collapses, inventory piles up, prices fall. We went from rates below 3% to rates above 7% in less than 2 years. That's one of the fastest rate increases in modern history, and it's already causing buyers to back out of contracts and inventory to stack up like cordwood. Second factor, wages. For a housing market to stay healthy, wages need to keep pace with home prices. That hasn't happened in over 20 years. Home prices have been growing way faster than wages, which means housing affordability has been getting worse and worse. Eventually, you hit a point where regular people simply cannot afford houses anymore, no matter how badly they want them. We're at that point now. The math just doesn't work for most buyers. Third factor, consumer confidence. When people feel good about the economy and their job security, they're willing to make big purchases like houses. When confidence drops, people get scared and pull back. Consumer confidence in housing is cratering right now because people are finally waking up to the fact that they can't afford these prices. When all three of these factors line up against the market at the same time, you get a crash. And they're all lined up right now. Let's talk about history for a minute because this isn't the first time we've seen these patterns. In the 1980s, Paul Volcker, who was running the Federal Reserve, jacked interest rates up above 17% to kill inflation. You know what happened to housing? It got destroyed. Home values dropped sharply. Sales volume collapsed. People walked away from houses they couldn't afford anymore. Then in the late 80s and early 90s, we had the savings and loan crisis. Deregulation led to a bunch of risky lending. A bunch of banks failed, and the housing market tanked again. Then came 2008, which was the worst housing crash since the Great Depression. Some areas saw prices drop 50% or more. Millions of people lost their homes to foreclosure. It was catastrophic. Now, here's what's interesting. Before each of these crashes, you could see the warning signs if you knew where to look. Rising rates, declining affordability, risky lending practices, overconfident buyers. Every single time, the same patterns showed up before the crash hit. And those exact same patterns are showing up again right now. The pandemic created this insane boom in housing. People were buying houses sight unseen, waiving inspections, paying tens of thousands over asking price. Rates were at historic lows, so everyone could afford to borrow massive amounts of money. Sellers were getting multiple offers within hours of listing. It was absolute madness. But now that boom is turning into a bust, and it's happening faster than most people realize. Here's something critical to understand about prices and inflation. A lot of people think that if there's a housing crash, prices will go back to where they were before the pandemic. Like if your house was worth $250,000 in 2019 and it's worth $400,000 now, they think a crash means it'll drop back to $250,000. That's not how it works because of inflation. The government is never going to let deflation happen. They can't. Deflation would destroy the economy and make the national debt impossible to service. So what actually happens is that home prices drop in nominal terms, but when you adjust for inflation, they drop even further in real terms. Let me give you an example. Say your house went from $250,000 to $400,000. If prices drop 20%, that's a drop to $320,000 in nominal terms. But here's the thing, because of inflation over the past few years, $320,000 in today's dollars is actually equivalent to about $250,000 in 2019 dollars. So in real purchasing power terms, the house is back to its pre-pandemic value, even though the nominal price is higher. This is how crashes work in an inflationary environment. The numbers don't drop as dramatically as you might expect, but the real value gets hammered. Now let's get into the actual warning signs that are flashing right now, because this is where things get really concerning. First, look at mortgage debt service ratios. The percentage of income that borrowers are spending on their mortgage payments is rising, and delinquencies are starting to tick up, especially among FHA borrowers. These are the people who put down the smallest down payments and typically have the least financial cushion. When they start defaulting, it's an early warning sign that the market is in trouble. So even more concerning, some lenders are approving debt-to-income ratios of 45% to 50%. That means people are spending half their gross income just on debt payments. That's insane. That's not sustainable. And when these people inevitably can't make their payments, we're going to see a wave of distressed properties hit the market. The relationship between wages and home prices is completely broken right now. When home prices grow faster than wages for long enough, you eventually hit a wall where people just can't afford to buy anymore. We're at that wall. The median home price is now something like 7 or 8 times the median household income in many markets. Historically, a healthy ratio is around 3 to 4 times income. We're way beyond sustainable levels. And here's where it gets even scarier. Lenders are pulling out their tools of last resort. We're seeing a rise in adjustable rate mortgages again. We're seeing subprime lending coming back. We're seeing zero down financing programs. These are the exact same tactics lenders use when demand is drying up and they're desperate to make loans. It's what happened before 2008, and it's happening again now. Adjustable rate mortgages are particularly dangerous because buyers are taking them to qualify for houses they couldn't afford with a fixed rate. They're betting that rates will come down and they'll be able to refinance. But what if rates don't come down? What if they stay elevated or go higher? These people are going to be trapped in mortgages they can't afford, and they'll have to sell or default. That flood of distressed inventory will push prices down even further. Here's something that should terrify anyone who just bought a house. Some markets have already crashed. Austin, Texas, already halfway through a crash. Home prices are down significantly from their peaks. Inventory is piling up. Sales are slow. Southwest Florida, same story. These markets went up the fastest during the pandemic, and now they're coming down the fastest. This isn't speculation. It's already happening. And it's not just those two markets. There are dozens of metros across the country in the beginning phases of crashes. You can see it in the data. Prices dropping, inventory rising, days on market increasing, price cuts everywhere. We're talking about roughly half the United States showing serious warning signs right now. This isn't some small regional issue. This is a national problem that's getting worse by the month. Let me show you what's happening with home builders, because this is one of the clearest indicators that the market is in serious trouble. Builder confidence is at 33 right now. Anything below 50 means builders are more pessimistic than optimistic about market conditions. They've been in negative territory for 15 straight months. These are the people who actually build houses for a living, and they're telling you the market is terrible. Even more telling, 38% of builders cut prices in July. That's the highest percentage since they started tracking this data in 2022. The average price cut is about 5%, but some builders are cutting prices by 15% to 25% cumulatively as they get more and more desperate to move inventory. They're also buying down mortgage rates for buyers, which means they're paying lenders to offer lower rates to make their houses more affordable. That's how desperate they are. When builders are cutting prices and buying down rates, that tells you demand is collapsing. Builders don't do this when the market is healthy. They do it when they're sitting on inventory they can't sell and they're getting scared. And this is a massive red flag that the market has already turned, and most buyers don't even realize it yet. Let me tell you a story that illustrates another problem in housing right now. There's a woman in Texas who inherited a home from her parents. When she got the house, she discovered there were $35,000 in back property taxes owed. She had no idea. She didn't even know about homestead exemptions, which could have saved her a huge amount of money. Texas has some of the highest property taxes in the country, along with New Jersey and Illinois. Here's what's happening. Property taxes are rising so fast that even people who own their homes outright are struggling to afford them. Lower income homeowners are getting hit especially hard because taxes are eating up a bigger percentage of their income. And a lot of inherited homes end up getting sold immediately because the heirs can't afford to keep them. This creates even more inventory in the market, which pushes prices down further. The overall market dynamics have shifted dramatically in favor of buyers, except buyers still can't afford to buy because of high rates and high prices. Active listings are up 29% year over year. That's a massive increase in inventory. Homes are sitting on the market for an average of 53 days now. Compared to homes selling in days or even hours during the peak, we've had 15 straight months of declining sales volume. Even the housing bulls are changing their tune. Mark Zandi from Moody's, who has been consistently optimistic about housing, is now calling the market uber depressed with bright red warning signs. When the optimists start sounding pessimistic, that's when you know things are really bad. The market has clearly turned and it's accelerating downward. The broader economic impact of this housing downturn is going to be massive. When housing crashes, it doesn't just affect home prices. It affects appliance sales, furniture sales, real estate agents, home inspectors, mortgage brokers, builders, contractors. The entire ecosystem around housing employs millions of people, and they're all going to feel the pain when this market fully crashes. Even homeowners who bought years ago with low fixed rates are starting to buckle under the weight of rising property taxes and insurance costs. Your mortgage payment might be low, but if your property taxes go up 20% and your insurance doubles, you're still in trouble. This is forcing some people to sell even though they have great mortgages, which adds even more inventory to an already oversupplied market. There's a real possibility that what we're heading into could be the worst housing market in American history, not in terms of, price drops necessarily, but in terms of overall pain and duration. The 2008 crash was brutal, but relatively quick. This one could be slower, more grinding, more painful because of how high prices went and how stubbornly they're likely to stay elevated even as the market deteriorates. Here's what really frustrates me. There's a huge education gap among new buyers right now. People are being pushed by FOMO and by financial gurus who keep screaming that you have to own real estate or you'll never build wealth. That these buyers are making the biggest financial decision of their lives without doing proper research. They don't understand debt to income ratios. They don't know about homestead exemptions. They don't understand how property taxes work. They're just signing whatever the lender puts in front of them because they're desperate to own a home. This is how people get destroyed financially. They buy a house they can't afford, take on a mortgage they don't understand, and then get hit with unexpected costs they never budgeted for. When the market turns against them, they end up underwater on their mortgage with no way out except foreclosure or a short sale. It's going to happen to millions of people over the next few years unless they wake up and start making smarter decisions. So, what do you do if you're thinking about buying? First and most important, buy within your means, not at the top of your budget. Well, within your means. I don't care what the, bank says you can afford. Buy less house than they'll approve you for. Have 6 months of cash reserves, not 3, 6 months minimum. Put 20% down if you can possibly manage it. Stick with fixed rate mortgages only, 30-year or 15-year. No adjustable rates, no exotic loan products. Don't count on refinancing in the future. Take a loan you can afford right now at current rates. If rates drop later, great, you can refinance. But don't bet your financial future on rates dropping. They might not. Diversify your investments beyond just your house. Stocks, gold, silver, Bitcoin, whatever, makes sense for your risk tolerance. But don't put all your wealth into one asset, especially not real estate at the peak of a bubble. Prepare for the worst case scenario, which is your expenses rising while your home value falls. Can you handle that? Can you still make your mortgage payment if property taxes go up 30%, if insurance doubles, if you lose your job for 6 months? If the answer is no, you can't afford the house, it's that simple. Look, I'm not saying everyone should panic and never buy a house. Home ownership can be a good financial decision if you do it right. But right now, at this moment in time, buying a house is one of the riskiest financial decisions you can make because we're at the peak of a bubble that's already starting to deflate. The warning signs are everywhere. Builders cutting prices, inventory piling up, sales slowing, delinquencies rising, risky lending practices returning. These are the exact same patterns we see before every crash. The details are different, but the fundamentals are identical. If you choose to ignore these warning signs and buy anyway, at least go in with your eyes open. Understand the risks. Prepare for the possibility that your house could lose 20%, 30%, maybe even 40% of its value over the next few years. Make sure you can survive that scenario. The people who are going to get absolutely destroyed in the coming crash are the ones who are buying right now with zero down, adjustable rate mortgages, 50% debt to income ratios, and no emergency fund. They're setting themselves up for financial catastrophe, and they don't even realize it. Don't be that person. Be the person who sees what's coming and makes smart decisions to protect yourself. The market is giving you clear signals. Builder confidence is in the toilet. Prices are being cut. Inventory is rising. Sales are falling. The only question is whether you're going to listen to these signals or ignore them, because everyone keeps telling you that you have to buy now before you're priced out forever. Newsflash, you're not going to be priced out forever. If anything, prices are going to come down, and people who wait are going to get much better deals than people buying at the peak. This is what always happens before a real estate crash. The warning signs flash. Most people ignore them. Then the crash hits, and everyone acts surprised. Don't be most people. Pay attention to what the market is actually telling you, not what your realtor or mortgage broker or financial guru wants you to believe. The data doesn't lie. The patterns don't lie. And right now, both the data and the patterns are screaming that we're heading into a crash. The only question is how bad it's going to be and how long it's going to last.